Hey everyone, Couch Investor back to another video for today. So let's talk about the big announcements from Disney. They announced a $60 billion investment for the next 10 years in the parks, entertainment, and product segments. Now, of course, when that news came out, a lot of people were thinking about this in a negative way, some people in a positive way. Analysts already made up their minds. We're going to go over a couple of notes later on in this video. But first, I want to show you this little announcement here, and I'll tell you why I view this as a positive thing and not really a negative one. So, this came out. The Walt Disney Company is providing the following update regarding its plan for capital expenditures at its Disney Parks Experience and Product segment. The company is developing plans to accelerate and expand investment in its Disney Parks Experience and Product segment to nearly double as compared to the previous approximately 10-year period. Consolidated capex for this segment over the course of an approximately 10-year period to approximately $60 billion in aggregate, including by investing in expanding and enhancing domestic and international parks and cruise line capacity. By the way, we know that cruises are doing extremely well. Well, parks and cruises are doing extremely well since the rebound after the lockdowns. So they're prioritizing projects anticipated to generate strong returns consistent with the company's continuing approach to allocate capital in a disciplined and balanced manner. We believe that the company's financial condition is strong and that its cash balances, other liquid assets, operating cash flow, access to capital markets, etc., will provide adequate resources to fund ongoing operating requirements, contractual obligations, upcoming debt maturities, because that's a big deal. There's lots of debt there. So one of the points that were made is why increase spending in parks when you already have that much debt, when you still have that Hulu thing going on, right? We're still talking about the ESPN. Are we going to sell part of it, partner up, etc.? All of those talks are still ongoing. Remains to be seen what happens. And also, especially the dividend is coming back. So in my opinion, it's a bit of a strange situation right now because the company is dealing with a lot of issues when it comes to linear, when it comes to foot traffic for the parks, when it comes to profitability of the streaming business. I mean, cash flows are becoming a bit better. The expectations there are also rising, but they're not at a level where I would say the company has the liberty to suddenly bring back the dividend and also increase the spending to $60 billion for the next 10 years. But maybe the company knows something I don't. I think we're going to see a similar thing that we're seeing with Intel, right? They've made those huge investments in a company that really didn't have much choice. They had to do that, but they found ways to finance that. Of course, the government is helping. Then they've got some financing offers, financing structures as well. They sold some parts of their business, all of that to generate some money to invest in those plans. Maybe we're going to see the same thing here with Disney. Remains to be seen. Now, this was bound to happen because, well, if you just looked at their presentation for Q3, you see here in the middle, Parks and Experiences making numerous investments to grow the business. We know that Parks and Experiences is the bread and butter of the business right now. It's been for a couple of years already. Of course, during the pandemic period, that segment took a huge hit since the parks weren't open, but the rebound, the reopening has been exceptional. Now, price hikes were viewed as a positive thing financially wise, but when you look at what's happening right now, maybe you're thinking of, well, the price is expensive, and so people don't really want to go back to a park that isn't really that innovative anymore. Nothing really changes. Said this in the past. If they really want people to come to the parks more often, if they really want to convince people that the price you're paying right now is worth it, then they need to invest much more in the parks. New rides, new experiences, expand, you name it. I mean, it doesn't always have to be physical, it can be digital. Right now, VR, AR, things like that, I think could make the experience much better, and that way you can convince people to spend that money. Now, that said, I still think it's pretty expensive to go to those parks. Now, for those that needed a quick reminder of Disney compared to its 10-year mean, of course, it is much cheaper right now, but the company is also a bit struggling currently. And so you're seeing PE, EV to EBITDA, price to sales in the next 12 months, and then price to free cash flow in the last 12 months. You can see the price right now, well, the metric right now is much lower than before. So PE, we're sitting at just under 18 times compared to 32.3 times. For EV to EBITDA, we're sitting at 11.6 times compared to 15.4. Price to sales 1.6 compared to 2.9, and then price to free cash flow 53.1 times compared to 66.9 times. And of course, I mean, you can clearly see when things change drastically, the pandemic hit, and so that's where you see that mountain forming, and then we went all the way back down because of course the stock crashed and the fundamentals were not really becoming a bit better. That said, we might be seeing that ship turning around. Whenever that will be, I don't know. I don't really see this as a Netflix or a Meta story where in 2 quarters, 3 quarters, the company is suddenly back to all-time highs or close to it. Now, before I continue, if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, would really appreciate that. We're very close to reaching 30,000 subscribers, so let's try and reach it by the end of the month. And if you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. And like I said previously, the overall parks business, the parks unit, is extremely important to the overall business. It's 36.7% of overall revenue, but if you look at the profits, that's 77.3% for this year. Now, we've got some comments here from an analyst at Morgan Stanley. So it says here, we see the parks and experience business, 75% of the fiscal 2023 segment operating income, as uniquely attractive in long-term growth potential, scale, and returns, warranting a low double-digit EBITDA multiple. By implication, at current Disney share prices, Disney's media assets in aggregate are valued at roughly $50 billion, less than 1 time sales, or about 30% of Netflix's current enterprise value. Of course, Netflix growing free cash flow, I mean, can't really compare that right now. Wells Fargo is staying overweight, noting the bullishness on parks and cruises, but adding that investors wanted to see more guidance from the company. While Disney is bullish on the parks opportunity, investors left the event a bit frustrated on what it all means for returns. The spending guidance is out there, but it's unclear if parks earnings growth should accelerate alongside spending growth. If earnings stay unchanged, then higher capex equals lower street free cash flow estimates. And last thing here, while parks value is good for the stock long term, we think for Disney to break out near term, it requires getting Hulu sorted and providing clarity on ESPN's future. Our bullishness remains content and direct to consumer. Wells Fargo has a price target of $110, implying around 33% upside. Now, I do want to talk a bit more about that $60 billion in spending and why a lot of people are talking about it in a negative way. I don't really see this as a negative way. This is a necessity. This is like, I've seen this example for Tesla, for example. It's like saying that every time that Tesla announces a new megapack factory, a new gigafactory, it should be viewed as a negative thing, a negative aspect, a negative hit on the business. Why? Why is that? It's a necessary move. It's a necessary investment. Of course, different industries, different companies, Tesla and Disney, but the move behind this is approximately the same. They invest to grow their business in the future. They will invest in the parks to make the parks even more appealing to more people, and so the parks maybe in the future can become even a bigger chunk of revenue and become maybe a bigger chunk of profits as well. Remains to be seen. But that's the reason why they invest. And I don't think that's a good reason why people start being negative. I'll be more negative if they don't invest in the parks business. Of course, do share your thoughts down in the comments below. Now we also have an update from a Bank of America analyst. They've reduced their price target to $110 per share from $135 previously, while reiterating their buy rating, reflecting the transition underway for Disney and the media industry in general. They see this investment as prudent to drive sustained long-term growth. They also say that they expect progress on these priorities could take several quarters, if not years, to materialize, but given Bob Iger's track record, okay track record if you exclude the Fox acquisition, and stature in the media industry, we continue to believe his steady leadership bodes well for the future performance of its stock. Of course, talking about the other parts of the business here as well, linear and streaming. And so here we are again with the graph. We're still in the same area as we've been in the past 4 times. So back in 2014, back in 2016, 2020, 2022, and then right now in the last couple of weeks, actually around that $82 area. Of course, if we can form a base right here, that could be very healthy. For the stock to go up in the short term, the market will have to see some major improvements in the next quarter and maybe even a guidance. We'll have to wait another month or so until we get those numbers. But those are my thoughts with regards to the $60 billion announcement. I view this as a positive thing. Am I buying Disney right now? No, but I do think that, again, that the risk reward here, the balance is highly in favor of the reward. Of course, do share your thoughts down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.